The Simple Path to Wealth, Your Roadmap to Financial Independence and a Rich Free Life by J.L. Collins. Key takeaways. Number 1. Spend less than you earn, invest the surplus, and avoid debt. Do simply this and you'll wind up rich, not just in money. Financial independence starts with discipline. The foundation of building wealth is straightforward. Live below your means and redirect the excess into investments. This approach not only grows your net worth, but also cultivates a mindset of financial responsibility. Debt is a wealth destroyer. Avoid debt like the plague, especially high-interest consumer debt. When you carry debt, you're essentially working for someone else's benefit. Every dollar spent on interest is a dollar that could have been invested and grown over time. Save aggressively. Aim for 50% or more of your income. Invest early and often. Take advantage of compound interest. Eliminate and avoid debt. Pay off high-interest debt first. Live frugally. Focus on experiences rather than possessions. Number 2. Harness the power of index funds for long-term wealth building. The harsh truth is, I can't pick winning stocks and you can't either. Simplicity beats complexity in investing. Index funds, particularly low-cost total stock market index funds like VTSAX, offer the most effective way for individual investors to build wealth over time. They provide broad diversification, low costs, and consistently outperform actively managed funds. Time in the market beats timing the market. Instead of trying to pick individual stocks or time market movements, focus on consistently investing in a broad-based index fund. This approach harnesses the overall growth of the economy and reduces the risk of underperformance due to poor stock selection or market timing. Choose a low-cost total stock market index fund, e.g. VTX. Invest regularly, regardless of market conditions. Ignore short-term market fluctuations. Let compound interest work its magic over decades. Number 3. Understand market volatility and stay the course. The market always goes up, always. Embrace market fluctuations. The stock market's long-term trend is upward, but the journey is rarely smooth. Understanding that volatility is normal and expected can help you maintain your investment strategy during turbulent times. Psychological fortitude is crucial. The biggest enemy to successful investing is often our own emotions. Fear and greed can lead to poor decision-making, such as selling during market downturns or chasing hot investments. Developing the mental toughness to stick to your investment plan through ups and downs is essential for long-term success. Expect and accept market crashes as part of the process. View market downturns as buying opportunities. Focus on long-term trends rather than short-term fluctuations. Educate yourself to build confidence in your investment strategy. Number 4. Embrace simplicity in your investment strategy. Complex investments exist only to profit those who create and sell them. Simplicity is powerful. A straightforward investment strategy using just 1 or 2 index funds can outperform complex portfolios managed by professionals. This approach not only yields better results, but also requires less time and effort to maintain. Avoid the noise of financial media. The constant stream of market predictions, hot stock tips, and complex investment strategies is largely noise that can lead you astray. Instead, focus on the fundamentals of low-cost, broadly diversified investing and tune out the rest. Use a simple portfolio of 1 to 2 index funds, e.g. VTSAX and VBTLX. Avoid actively managed funds and their high fees. Ignore market predictions and stock-picking advice. Spend your time and energy on other aspects of life. Number 5. Maximize tax-advantaged accounts for optimal growth. None of these tax-advantage buckets eliminates your tax obligation. They only defer it. Leverage tax-advantaged accounts. Utilize accounts like 401ks, IRAs, and Roth IRAs to maximize your investment growth. These accounts offer tax benefits that can significantly boost your long-term returns. Understand the tax implications. Each type of account has different tax treatments and rules. Knowing how and when to use each type can help you optimize your tax situation both during your working years and in retirement. Prioritize contributions: 401k to employer match, then IRA, Roth IRA, then max out 401k. Consider tax diversification, mix of pre-tax and Roth accounts. Understand withdrawal rules and required minimum distributions, RMDs. Use HSAs as a powerful triple tax-advantaged investment vehicle. Number 6, plan for retirement with the 4% rule and flexibility. 4% is only a guide. Sensible flexibility is what provides security. The 4% rule as a starting point. This guideline suggests that you can withdraw 4% of your portfolio value annually in retirement with a high probability of not running out of money. It provides a useful benchmark for retirement planning. Remain flexible in retirement. While the 4% rule is a good starting point, it's important to adjust your withdrawal rate based on market conditions and personal circumstances. Being willing to cut back during market downturns can significantly improve the longevity of your portfolio. Use the 4% rule to estimate your retirement portfolio needs. Be prepared to adjust spending in response to market conditions. Consider part-time work or side hustles in retirement for added flexibility. Regularly reassess your withdrawal strategy. Number 7, beware of financial predators and stay vigilant. Everybody can be conned. Financial literacy is your best defense. Understanding basic investment principles and being aware of common scams can help protect you from financial predators. Remember that if something sounds too good to be true, it probably is. Be wary of conflicts of interest. Many financial advisors and investment products have inherent conflicts of interest that may not align with your best interests. Understanding these conflicts and seeking out fiduciary advisors when necessary can help protect your wealth. Educate yourself on common investment scams and tactics. Be skeptical of investment opportunities that promise high returns with low risk. Understand the fee structures of any investment products or advisors. Trust your instincts and don't be pressured into quick decisions. Number 8, Social Security. Understand its future and plan accordingly. If you are 55 or older, you'll collect every dime. Social Security's future is complex. While the system faces challenges, it's unlikely to disappear entirely. However, younger generations may see reduced benefits or increased retirement ages. Optimize your benefits. Understanding how Social Security works and strategizing when to claim benefits can significantly impact your retirement income. Consider factors like your health, family longevity, and spousal benefits when deciding when to start claiming. Don't rely solely on Social Security for retirement income. Consider delaying benefits to increase monthly payments. Understand how working in retirement affects your benefits. Stay informed about potential changes to the system.